Hello everyone, welcome to EPK Capital's YouTube channel. On this channel, we would be discussing and learning about investments, wealth management, and everything else from the world of finance. We would also analyze and understand different products in much more details in near future. So without wasting any more time, let's get right into it. In this video, we are going to understand what are bonds, who issues bonds, types of bonds, and pros and cons of bonds. Bonds are debt securities that represents loan made by investors to entities such as corporations, municipalities, and governments. Bonds are a form of fixed income investment as they typically pay a fixed interest rate, what we also know as coupon rate, over a specified period of time until maturity, at which point the principal is repaid. Bonds are issued by entities to raise capital for various purposes, such as financing projects, funding operations, or managing cash flow needs. Bonds are issued by government, corporations, and municipalities. Government issued bonds are known as government bonds or treasury bonds. Corporate issued bonds are known as corporate bonds. Municipality issued bonds are known as municipal bonds or munis. Other entities such as international organizations, government agencies, and special purpose vehicles, which is a long form of SPVs, may also issue bonds. These entities are collectively known as bond issuers. Now there are multiple types of bonds. We are going to learn about some of the type of bonds which are very commonly used. Government bonds issued by governments such as US Treasury bonds and are generally considered very low risk. Corporate bonds issued by corporations to raise capital for business operations or expansion and can vary in risk depending on the creditworthiness of the issuer. Municipal bonds issued by state or local governments to finance public infrastructure projects and their risk level can vary. Treasury inflation protected securities or TIPS. Bonds issued by US Treasury that are designed to protect investors against inflation by adjusting the principal and interest payments based on changes in consumer price index, which is CPI. Next is zero coupon bonds. Bonds that do not pay periodic interest but are issued at a discount to their face value, with the full face value paid at the maturity. Convertible bonds. Bonds that can be converted into predetermined number of companies' common stock shares at a later date. Junk bonds. Bonds issued by lower rated companies with higher risk and higher interest rate to compensate for the risk or the increased risk. Coupon rate and several other factors can significantly affect the performance of bonds. Here are some key factors. Coupon rate. The coupon rate is the fixed interest rate that bond pays to its bondholders. A higher coupon rate generally leads to higher income payments to bondholders, which can positively impact a bond's performance, especially in a low interest rate environment. Conversely, a low coupon rate may result in lower income payments, which can impact bonds' performance negatively. Second is market interest rates. Bonds are sensitive to changes in market interest rates. When market interest rates rise, newly issued bonds tend to have a higher coupon rates, making existing bonds with lower coupon rates less attractive to investors. This can result in decrease in demand of existing bonds, leading to decrease in their prices and potentially impacting their performance negatively. Conversely, when market interest rates decline, existing bonds with higher coupon rate may become more attractive, potentially leading to an increase in demand and an increase in bond prices. Credit risk. Credit risk refers to the risk that the issuer of the bond may default on interest payments or fail to repay the principal amount when the bond matures. Bonds issued by issuer with lower credit rating or higher credit risk generally offer higher coupon rates to compensate for the additional risk that investor is taking. Bonds with higher credit risk tend to have higher price volatility and may be more susceptible to negative performance if the creditworthiness of the issuer deteriorates. Fourth is maturity date. The maturity date of a bond is the date when the principal amount of the bond is repaid to the bondholder. Bonds with longer maturity dates generally tend to have higher price volatility and may be more sensitive to changes in the market interest rates compared to bonds with shorter maturity dates. This is because longer term bonds have a longer time horizon for potential changes in the interest rate to impact their performance. Another very important thing to keep in mind is call features. Some bonds may have call features that allows the issuer to redeem or call back the bonds before their maturity date. Callable bonds typically offer a higher coupon rate compared to non-callable bonds to compensate for the call risk. If a bond is called, bondholder may need to reinvest their proceeds in a lower interest rate environment, which can impact the overall performance of the bond. Next is inflation. Inflation can erode purchasing power of bond interest payments and principal over time. Inflation expectations can impact the performance of bonds with higher inflation expectation potentially leading to higher market interest rates, which can negatively impact the bond prices and performance. One of the best way to navigate or mitigate this risk is by investing in bonds which are inflation protected, like TIPS issued by US Treasury. 7 is market condition and supply or demand dynamics. Overall market conditions such as supply and demand dynamics for bonds can impact bond performance. Factors such as changes in market liquidity, overall economic condition, geopolitical events, and investor sentiments can impact the supply and demand of bonds, which can affect bond prices and performance. It's also important to note that performance of bonds can be influenced by a combination of these factors and can vary depending on the specific characteristics of bond, market conditions, and other external factors. Careful consideration of these factors and their potential impact is important when evaluating the performance of bonds as investment. Consulting with a qualified financial professional can provide additional guidance and insight tailored to an individual's specific investment goals and risk tolerance. I hope this video helped you understand bonds at a high level. If you have any specific question, do write them in the comment section and we would try to answer them. In case if you like the video, please do consider subscribing to the channel and like the video. Also, if you are looking for any wealth management services or wish to do any kind of investment, do head over to our website and get in touch with us on the email mentioned below. We specialize in investment in India, UAE and other international options. Thank you for watching.